In 1973, I was director of economic research at the Control of the Currency. He comes into my office and he says, Harold, we have advocates who are saying that banks are discriminating against minorities in the provision of home mortgages. The only thing we have is anecdotal evidence. Go find out if this is true. Anecdotal evidence is wonderful. That's when you see these vignettes about people. But just because there is anecdotal evidence, because we can find a case of abuse, doesn't mean that that is widespread. So let's go find out if that's the exception or is that the rule. All right. Well, in this past Congress, Senator Durbin introduced legislation to impose a 36% usury ceiling. National usury ceiling on consumer lending. Now, that's the magic 36%. Well, Durbin was just proving what the philosopher Santayana once said. And you remember, that is, those who do not know history are condemned to repeat the mistakes of the past. What I say is a variant of that. Those who know history still are condemned to make the mistakes of the past. Because let's look at this particular issue. Restriction on credit through interest rate ceilings is perhaps the oldest legislative enactments in history. Ever since the advent of writing, we have cases in which this is correct. Aristotle wrote that money was sterile, and so you shouldn't charge interest. The Catholic Church had usury, the lending at positive rates of interest, as a cardinal sin, condemning you to die, not die, you don't die. You burn in hell for eternity. Each one of the 13 colonies imposed usury ceilings. You know of the Russell Sage Foundation at the turn of the century actually commissioned a study because of the restrictive usury ceilings in the states to try to find a way that consumers could have access to credit from reputable lenders at relatively low rates. And in 1907, 1910, Russell Sage Foundation published a study that said that they thought that the reasonable rate of interest that should be charged on short-term consumer loans was 3% per month. That's an APR of 36%. Okay, look at me like that. I find that interesting, don't you? That we come up with the same rate of interest, 36% in 1900, as you're going to come up with in 2010 with Durbin? And when was the talent? Nelson. Remember, one of those people was running for re-election and thought this would help him? Okay, so it was that election, whatever election that was, 2006? All right, so look. So 36% seems to be the magic number, because it's a number, as I say, we still hear today. Now, here is the thing about this particular sort of action. One has to say, why is it that we impose these laws? For what purpose? There are a group of people, of course, who will say that we are doing this in order to protect consumers, undoubtedly, from themselves. We are going to write an act to say it is un-American to be able to borrow money at a certain rate. But let's take a look and see what will be the impact of this. I do not know of a single study, I cannot find a single study that tells you that there are beneficial effects from imposing interest rate caps on consumers. Now, it's amazing. We're talking about going all the way through time. Now, I can find studies that will say if we impose these caps or if we restrict this type of lending, consumers will save $3.4 billion. Well, the way they get that number is that they are looking at the finance charges that these customers are paying. They are not looking at this ex post. They are not going to see what are the costs imposed when this access to credit is cut off. If you look at those studies, and there are some, there's one in North Carolina, there's one in Oregon that's particularly of interest. But what these studies show is that the consumers actually become worse off, that they have increased debt burdens, that the cost of credit to them goes up, that they resort to borrowing from higher cost lenders, pawnbrokers, payday lenders, title pawn shops. Check overdrafts increase dramatically as well. All right? And as a consequence, their total finance costs go up because they are not borrowing for trivial purposes. They are borrowing so that their children won't sleep on the floor, or they're borrowing so they can bring their husband back from Afghanistan. They are not borrowing for trivial purposes. And so when you remove access to credit from regulated lenders who have reputable reputations, then instead of being wealth enhancing, it is wealth destroying. That I can give you many, many sources of that. I cannot find evidence to the contrary, and I have read the writings coming from most advocacy groups, including the very famous one that is here in North Carolina. Let's look at some of the arguments. One argument is as follows, and I will find it in 1 second. And that is, high interest rate borrowers are naive and uninformed. Now, that would assume that those people who are borrowing, even though the terms of loan are disclosed to them, don't understand it. Well, there is a very famous study that goes out and looks at customers who borrow from high interest rate lenders. Here's what it turns out. They understand perfectly the cost of the loan. They understand perfectly that that is a low-cost alternative to other sources of borrowing that's open to them. What they don't understand is APR. But they shouldn't feel bad, neither do my students, and they are seniors in college. Because, look, APR assumes, you know this, APR assumes to get that number, you will have to borrow that money for a year, and if it has a shorter term maturity, you have to roll it over for 1 year to get to that number. So if you have a short-term loan with a short-term maturity, even if you charge the slightest fee, like an application fee, if you put the numbers into an APR calculator, you're automatically going to generate triple-digit APRs. One of the exercises I give my students is I say, how much is it if you overdraw your checking account? And they'll say, $34. I say, figure the APR on that when you write a bad check. And on Friday, it bounces, and you cover it on Monday. And then they come up with 1,250%. APR is not the mechanism that is important here, but the cost of the loan is what is important. And the problem is we all get hung up with APR. Because people will say, that is an APR of 350%. Isn't that awful? You know what the answer is? Yes, it is awful if the term of the loan is 12 months and you have to pay that. But we are not talking about issues like that. We're talking about short-term loans, and we're talking about the necessary fees that have to cover that cost. Look, understand one thing. If this were a low-cost business, being able to provide these at low cost and low fees, then everybody would be doing it. There is a reason why the banks don't do this. When I was at the National Credit Union Administration, I was appointed by Jimmy Carter. I was part of the Georgia Mafia to run that agency. We had community development credit unions who were supposed to provide low-cost lending for members of their community. Do you know that once the federal subsidy went away, virtually all of those credit unions went away as well? Because it was not a profitable activity. It was not a profitable activity. If it were profitable, more and more lenders would do it. But understand that the profit margins from all of the studies I've seen for small consumer lenders are much less than the profit margins for banks who are located in the same MSA. They would be profit margins that would be unacceptable to the banks. Why? Well, we just heard a description of that. These are high-touch loans. These are loans from providers who give convenience to their customers in hours that the bankers don't have, in services that the banks won't provide. And as a result, one would anticipate that the fees for providing that service should be higher. Also, the clientele is different from the bank's traditional clientele, because there are aspects about them, even in the face of high credit scores, that make them different than the normal clientele of the banks, or the credit unions for that matter. And so as a result, we have these specialty lenders who come and provide these type of services to this particular clientele with this particular need set. Now, here's what the studies have shown. It compares, I've seen studies compare one state with another. Oregon with Washington, once Oregon enacts strict usury ceilings. And then it looks at the well-being of the people who are clients in that industry. And what they found is that the debt burdens increased in Oregon relative to Washington, that bankruptcies increased in Oregon relative to Washington. They also found that when caps are raised, that many of these problems go away. There is another compelling study that shows that in the states that have no usury ceilings at all, that debt burdens are significantly lower than in states that do have usury ceilings. There's another interesting hypothesis as well. Oh, but coming back to the first point, it turns out that the clients are neither naive nor are they uninformed, and that they are making rational decisions given the cost of credit as to where to go borrow. The second thing is the notion that high-interest customers are vulnerable to exploitation. That means that, and you'll have to pardon me because this does really irritate me, when I read about groups subject to exploitation being minorities, women, and the poor. Doesn't that infuriate you women when people say that? I know it infuriates me as a minority, to hear that all of a sudden I'm vulnerable to exploitation because of my color. Now, what makes one vulnerable? Well, the evidence, once again, doesn't point to vulnerability. When you look at clientele, for instance, it is not surprising that compared to bank clientele, that those who go to small loan companies are at the beginning, in many instances, of their adult life cycle. They're young families who have higher debt burdens and who are credit constrained. But this is part of the entire life cycle. And when you look at what economics tells you, those same people then mature and graduate into net savers. And that this, just like me working as a teenager for minimum wage and bussing tables because my father believed that I should not sit around the home in the summertime, that was not a permanent job for me. But that job was essential in me learning about work and showing up on time and developing the habits that would be ingrained into me to make me a useful member of the workforce. Well, it turns out that in many of these cases, that is exactly one of the services being provided by this industry. And if you take that away, then one of the things you're going to do is to damage the financial development of many in our population. So that's another thing to consider. And another hypothesis that I looked at is this notion that high rate lending destroys consumer welfare. And that is this whole notion of this cycle of debt and debt trap. Now, one would assume then that if you eliminated this type of lending or made it more restrictive, that wealth then would somehow magically increase among the people who were these customers. In actuality, the research shows just the opposite happens, that this group becomes worse off when this type of lending is restricted. And so when you look at those three particular hypotheses in any great depth, you can find that none of them are actually true. If you look at the benefits from this, certainly the benefits certainly outweigh those anecdotal stories about abuse. And let me just tell you a personal story about that. When I was at the National Credit Union Administration, we had a congressman who was going to introduce legislation based on consumer abuse that was going to be harmful to the credit union industry. It was going to cost the credit union an enormous amount of money to conform to this regulation. Let me give you a brief example. Truth in Lending was modified a few years ago, and there was one line of modification. Well, there is a study to show the cost of government that went out and found what was the cost just to the banks of changing one line in Truth in Lending. And they found it went into billions of dollars because you had to change all your literature, you had to change your disclosure, you had to change the training of your people, and just one line will do that. So I went to this congressman and I said, I talked about that exact thing. And he looked me in the eye and he says, I don't care. I've got a constituent who's complained, and I want this legislation to address that problem. Even though we told him we already had regs in place that would address it, and that legislation would be more harmful than serve a positive purpose. Fortunately, it did not get out of committee because the rest of the Congress people realized that. And so it never, ever made it to the floor. It never was considered. All right. So on a profit basis, on a price gouging basis, there isn't any evidence that that occurs. Look, why do you want to price gouge your customers? Because customers talk. They compare notes. They don't come back. You don't get any more business. You go out of business. Why in the world would you take any sort of action that is going to damage your own credibility? That's beyond me. The main point to take away from all of this is very simple. Now, once again, maybe you can help me out on this. I can't find any evidence that talks to the benefits to the class of consumers who use this service when this service is taken away. And yet I can give you example upon example through the use of econometrics and statistics and studies from hopefully people who are as agnostic as I am about research that shows the harmful effects of all of this. See, look, yes, I know that high interest consumer lending has gotten a bad reputation. And I know in large part that reputation and that it's fueled by the fact that these end up being high APR loans, and that is the main thing that's used. Do you know that loan is 160% APR? Well, look, I've got a quote in here from FDIC Chairman Sheila Bair that says that the reason why banks and credit unions don't make this type of loan is, one, it will impinge upon the profitability of their overdrafts. She said this in 2005. And so they don't want to impinge upon that profitability. And the second, and the important one in here, is that it is costly to provide this service. And they can provide other services at less cost, and it will be more profitable. So as I have said many times, in large part, this bad reputation is due to, one, lack of evidence and a lack of intellectual aggressiveness. It's like my students who are intellectually lazy. And because they're intellectually lazy, they will give me an answer that is the product of their environment and their teaching and what other people have said. And yet, when those same people are asked to analyze it like we do in class, they will come up with a different answer. Because remember the words of the infamous Joseph Goebbels, Hitler's Minister of Information. And that is, if you tell a lie often enough, it will replace the truth. Do I have any questions? You believe everything I said? That is wonderful. Remember, and I say this all the time, I've been in Tennessee 24 years, and Tennesseans will say, I do not have a dog in this hunt. And as I tell people, what I say is based on my findings and not my priors. And so if you can prove me wrong, please do it, and I will then adopt your position.